Hello everyone. Good evening to everyone here. I'm Yikai from Fund Supermart. Welcome to this evening webinar, a review of a hectic first quarter of 2023 and the market outlook for the rest of 2023. In the current environment, every quarter seems to be a roller coaster ride. 2023 started off positively, but any sense of joy was wiped off when SVB and Credit Suisse collapsed, sending shockwaves across the markets. The strength of the banking industry was placed in doubt. However, investors have short-term memories and optimism is starting to rebuild. But is the optimism justified or is this a mirage that we are facing right now? With me right now, I have Colin Low, Assistant Manager of Research and Portfolio Management of IFAS Singapore. He will be sharing our views on the year ahead while also giving us an update on our MAPS portfolio at the same time. Additionally, Colin will be happy to answer any questions that you have after his presentation. If you have any questions along the way, feel free to put them into the Q&A box and our speaker will get to them over the course of this evening. Then without further ado, let me pass over to Colin to start the webinar going. Colin, please.
Hi everyone, I'm Colin, Assistant Manager of our IFAS Research and Portfolio Management team. And I also help to manage the MAPS portfolio. And today I'll share on how the MAPS portfolio have performed in the first quarter of 2023 and also on our updated outlook for the year. Okay, right, let's dive in. So the first quarter of this year was a continuation of last year's positive performance. As you can see from the table here, global equity rose by 6.7% as shown right over here, mainly led by developed markets or DMs in short. So within the DM markets, US gained 6.7% in the first quarter, which is led by a very strong rally in growth stocks as the markets began to price in more rate cuts in the second half of this year. So this is why if you look at our digital economies exposure, which is represented by the all-shares Global Internet Giant Index, you can see that it jumped by a whopping 17.6%. So moving on to Europe, you can see that Europe also generated strong performance across both quarters after being sold off in the middle of last year. So a big part of it was the easing of the energy crisis, the headwinds generated from the energy crisis, and that led to a rebound in European growth. So that optimism also rebounded in European equities, and that carried the market for first quarter of this year. So if you look at Japan itself, Japan's performance is also starting to gain steam. While it has been slow in the last quarter, but it is slowly and steadily building up steam. So with sentiments getting stronger towards the region as well as towards the currency. So what we are seeing right now is Japanese stocks, especially those that have a high exposure to China, and also those growth stocks that were beaten down badly last year have started to rebound quite significantly. So that drove the market higher. So let's move on to emerging markets, or EMs in short. So you can see clearly that China rose about 3.9%. So that that is lesser than what we've seen last quarter, but it definitely helps to uplift Asian equities this quarter. So if you can see, the MSCI Asia ex Japan index rose about 3.6% in the first quarter. And on the other hand, commodity players like your EMEA and Latin America had also had a more challenging quarter as compared to their Asian counterparts, but more so for EMEA because commodity prices actually fell in the quarter. So this happened as the market expect demand to drop as global growth is expected to slow even further after the banking turmoil in the West. So the reason why EMEA saw a negative return was because of its heavier reliance on oil prices. So in contrast, if you look at Latin America, it has a decent exposure to metal prices, where prices for the past quarter were more supported by a rebound in construction activity as a result of China's reopening. Therefore, that is a reason for the discrepancy in performance. But let us move on to the bond segment. So within the fixed income markets in general, you can see that it also performed relatively well in the first quarter. So global bonds returned a solid 3% after last month's even better 4.5% gain. So riskier segments, you can see like the high yield bonds, the EM debt extended their strong performance for this quarter. So with US high yield being one of the best performer and returning 3.1% as spreads tightened a little bit. So the safer segments like your global as well as your Asian bonds, which are largely of investment grade nature, have also caught up and performed well this quarter. So the recent resurgence of recession fears have definitely drove the performance for this investment grade bonds in general over the past month, and that helped uplift the performance for this more safer segments as compared to what we've seen the last quarter. All right, so let me now dive into the portfolio's performance over the past quarter for both growth and income. So as you can see, given the decent market performance across both equity as well as fixed income markets, our portfolios generally did well. And overall, growth portfolios returned about 2% to 4.8% in the first quarter. So the performance was quite similar to last quarter, where we returned around 2 to 4.5% across our growth portfolios. So the strong performance in the first quarter was the result of two factors. So number one, strong portfolio returns in January, where we beat the benchmark. And number two, resilient performance in February, where the declines were less than the benchmark, especially for more of the conservative portfolios. But however, the March performance was a little bit of a drag as we underperformed the benchmark. So for similar reasons, our income portfolio also fared well. So overall income portfolios returned between 1.7% to 4.1% in the first quarter, slightly lower than growth portfolios. So one thing I would like to highlight here is that our income portfolios tend to be more defensive because we chose couple of dividend strategies instead of growth strategy for certain regions. And this means that the portfolio declined much lesser than such as those seen in Feb as compared to the growth portfolios. And at the same time, we definitely have a higher dividend yield for the income portfolios, and that also cushioned the portfolio's performance in volatile months such as those we've seen in February. All right, so now let's take a look at how it fares against our benchmark. And unfortunately, we have underperformed across the portfolios in the first quarter against the benchmark. So this was largely due to much underperformance, as we have largely outperformed the benchmark in January and February, but March was a month that dragged the portfolio performance down. But one thing I would like to highlight here is that our portfolios are positioned quite defensively right now, which you will later see. And as a result of that, we may not fully capture rallies in the markets. However, if market capitulates or sells off, our portfolios will be more protected. And this also means that we will be able to better defend the gains that we have previously captured in the event of a sell-off. So the same can be said for our income portfolios, where we have also underperformed the benchmark across the different portfolios in the first quarter. And again, this was largely due to much underperformance. And I just want to say that for our income portfolios, there were times where we underperformed, but when we underperformed when market rallied because of our more defensive nature of the fund selection, as well as the dividend distribution. But in times when markets are down, the defensiveness of the portfolio will shine. So now let us take a look at the performance of our fund picks. So on aggregate, most of our developed market fund picks beat the benchmark in the first quarter. So the predominant theme in the first quarter was the rebound in growth stocks. So you can see this quite clearly across the performance of growth type funds for the US and Europe, as well as the OGIC ETF, with all of which I've marked out on the slides. And all of these funds and ETF posted double-digit jumps in the first quarter. However, on the flip side, the value funds which have done relatively well over the past 6 months to a year, they have underperformed for the past quarter as a result of the rally and reallocation into growth style funds. So for emerging market funds, the performance against the benchmark was roughly mixed in the first quarter. So growth style funds like the Shodan Asia Growth Fund, as well as the BlackRock Asian Growth Leaders outperformed, while our EMEA and Greater China Fund underperformed. So for our technical ideas, most of them underperformed the benchmark in the first quarter. However, our semicon exposure, which you can see represented by the Banner Vector Semiconductor ETF, significantly outperformed, returning up close to 30% over the past quarter. So that actually outperformed the benchmark significantly, and that helped to narrow the performance gap. Something I like to note is the BlackRock World Financial Fund. So this fund itself was hit badly over the past month as a result of the banking crisis in the West. However, the underlying exposure to those banks that are involved are relatively minor for this fund. So moving ahead, while sentiments are still relatively poor for the banks, we do expect the performance, the underperformance to stabilize moving ahead. So the picture for our fixed income funds is largely the same, like our equity funds. Most of our fund picks underperform the benchmark for the fixed income fund. However, most still managed to generate a positive return, so that kept the performance gap tight over the past quarter as well. So moving on to the recent portfolio actions made in 4Q last year, as well as the 1Q this year. So for those of you who are here for the update for the previous quarter, you should have heard me talk through the changes that we made in December. And we have made a total of 6 changes in December with the intention of making the portfolio more defensive and to position for further downside and volatility. So this is something that we still strive towards as well. So in March, as a result of this belief, we made 4 changes. First, we increased our allocation to fixed income from neutral to overweight to take on a more defensive positioning. And second, we cut our Asia ex Japan equities from overweight to neutral. And as a result, we increased Japan, which is one of our favorite equity pick. We increased it to further overweight. And next, to de-risk in our bonds allocation, we cut Asia high-yield bonds from neutral to underweight and reallocate that to Asian investment-grade bonds, pushing it from underweight to neutral. And lastly, on a fund level, we also added a Japanese equity fund with a value tilt to take advantage of a more resilient and what we believe as a better Japanese value segment. So with regards to our rationale on making these changes, I will run through them later when I share more on the market outlook, which I will elaborate after this presentation for MAPS. And as a result of these changes, here's our current allocation. So for fixed income, we are overweight the safer and higher quality bonds like the SG-centric bonds and global bonds. At the same time, we remain neutral on Asian IG bonds, having raised the weight up by 2.5% from underweight to neutral in the previous round of changes. And on the other hand, we are underweight riskier segments such as your Asia high yield, global high yield, and emerging market bonds, which we think are more at risk in the current macro backdrop. For equities, we remain overweight Japan, one of our top favorite markets at the moment. We have recently raised it even further overweight and an overweight position about 5%, so moving from 8.5% to 11%. And at the same time, we are also neutral across most of the equity markets in our portfolios. So there are 2 markets which remain underweight, which is Europe as well as the more growth-heavy digital economy stocks. So a big part of it is, of course, the macro backdrop as we believe is weighing down on the prospects of both these countries and sectors. All right, so with that, I come to the end of the portfolio MAPS performance update. So next, I'll be sharing our market outlooks for April, and this will help you understand in detail why we made those changes in March. So maybe let me start off with a quick recap of the month of March. So the month of March itself was an interesting month, was a chaotic as well as a hectic month. It was a tale of two halves as global equities were down in the first half due to the banking turmoils in the West, and also a resurgence in China and US tension as well earlier on in that month. But equity markets have generally rebounded in the second half of March as optimism starts to rebuild itself. But as this happens, we cannot help but remain cautious as we see increasing risk of a US recession. So maybe let me share some of the reasons why. And as you can see from the chart on the left, which shows the market expectation of policy rates versus the Fed's expectation of policy rates through its FOMC dot plot. And as you can see, markets and the Fed very much disagree on the path of interest rates. From the dot plot, the Fed is expecting about 1 to 2 more rate hikes, so ending the year at about roughly about 5.13%, which is the median estimation right now. And that also shows that based on the Fed, there will be no rate cuts this year. However, markets themselves are pricing in 2 to 3 rate cuts in the second half of the year. And because of this divergence, we think that markets are underestimating the Fed right now. So the continuing tightness in the labor market, as well as the sticky inflation, will make it hard for the Fed to cut rates this year. So the impact of rate hikes tend to lag by about 6 to 12 months, which means we are and will continue to experience the impact from last year's rate hike. So as many of you can remember, last year in the middle of the year, we saw jumbo size rate hikes all the way to the end of the year, and some in this year as well. So those impacts will lag by about 6 to 12 months and will show up in economic data this year. And in fact, they are starting to show right now, as you can see, that data, especially the more prominent ones from retail sales as well as from housing data, can see that those are starting to slow at the moment. So by holding rates higher for longer, the economic impact will snowball and increasingly weigh on economic growth in the US this year. And if you look at the chart on the right-hand side, you can see that leading indicators have fallen. So that is denoted by the black line. And it is also pointing towards a slowdown in the US economy this year. If you see, there is a very strong correlation with the GDP on a year-on-year basis versus the leading indicator, changes in the leading indicator on a year-on-year basis. So that is one of the good telltale signs that the economic growth will definitely slow this year. Also, on top of that, recent happenings across the US banking sectors have also become economic drags. So while the fallout from the banking turmoil has largely been limited to regional banks, credit conditions in the US will likely deteriorate as the banks become more conservative and tighten their lending standards. So before the SVB collapse, US banks already are tightening their lending standards as economic growth deteriorated. So this will likely persist. So you can see this on the chart here where the black and gray lines both spike. So the spike in the lines themselves represents the tightening of lending standards by the US banks. So with the expected contraction in business loans, in consumer loans, we do expect a bigger credit drag in the second half of this year. So this will have negative implications for the labor markets. Again, this is shown on the chart. So whenever the credit condition worsens, so whenever the banks tighten their lending standards, and whenever the black and gray line spikes, the labor market worsens. So you can see that through the blue line where the unemployment rate spikes afterwards. So simply put, what happens is when credit condition worsens, businesses tend to cut back on hiring and step out on retrenchment. And as a result, unemployment climbs. So ultimately, higher unemployment will reduce the disposable income, the spending power of the consumers, as well as create ripples effect across the different sectors. And ultimately, all this will weigh down on the US economic growth. All right, so as all these are happening, we think that the risk of a recession looks increasingly underpriced, and there are definitely several telltale signs in the market right now. So the more obvious ones are in asset pricing, as well as being reflected through consensus estimates. So there are a couple of examples I cited here, the more obvious ones. So the first example, you can see that equities have rebounded off their 2022 lows quite strongly. In fact, even as macro data around the world have moderated. So this is something that is not just specific in the US, but also happening across the world, and even in China, where the country just reopened. And secondly, the price decline as well as the valuation contraction that we have seen thus far as compared to the COVID highs are definitely far from recessionary levels. And in fact, valuations have even expanded in some regions. For example, in Asia, as you will see later, valuations have climbed during this period. So this is also another telltale sign that there could be more pain when it comes to price decline as well as valuation contraction. So thirdly, when we look at the forward earnings estimate, so the earnings estimates from consensus for both fiscal year 2023 as well as fiscal year 2024, they are definitely looking unrealistic, especially with a weaker growth outlook. And lastly, if you look at credit spreads for bonds, particularly for higher yield bonds, they have definitely narrowed after widening significantly last year. And they are right now also nowhere near recessionary levels where it should be much, much wider. So overall, with markets still pricing in a soft landing, we do expect further equity downside as well as maybe certain fixed income downside, especially the riskier segments, and also more volatility in asset markets ahead as the recession risk starts to materialize and the market starts to price that in. So in light of this rising recession risk, we maintain our preference for bonds over equities. So the reasons are pretty straightforward. First and foremost, global bond yields are attractive right now. So they are at levels last seen during the GFC. And secondly, higher yields do provide investors with a real alternative to stocks. For example, if you look at the high quality investment grade bonds, they are offering a yield of between 3.4 to 3.5% right now, which is more than double that of the S&P 500's estimated dividend yield of about 1.6 to 1.7%. And thirdly, valuations of bonds have also turned much more attractive versus equities. So the chart here shows that the spread between earnings yield and bonds yield are at a decade low, are near a decade low right now. So this spread itself is the implied payoff or the implied compensation for investors in investing in equities over bonds. And this compensation is in fact ultra low right now. So in other words, investors themselves are poorly compensated for taking on equity risk. So why take on this risk if you're poorly compensated and you can take on another asset class that gives you a better payoff, such as high quality bonds. So in short, these are also the reasons why we decide to increase our fixed income allocation in the MAPS portfolio, so moving it to an overweight position. So moving on, let me share the areas that we like and dislike in equity markets and bond markets right now. So starting off with equities. So our views for equity have not materially changed despite the volatile months. So Japanese equities remain our top pick, and also it's a major reason why we increase equity allocation in our MAPS portfolio. So there are a couple of good reasons. Firstly, Japanese equities remain underpinned by a very strong reopening tailwind. So we do expect a better economic outlook in Japan versus other developed markets such as Europe and the US, as well as the other developed markets like the UK, for example. So with a better economic outlook, we think that supports the relative performance for Japanese equities. And secondly, corporate balance sheets for Japanese companies remain very strong. So unlike the other developed market peers, Japanese companies are entering the global slowdown with historically high cash-rich balance sheets, which can be deployed to defend operating performance and also to recover the operations when the recession is through. So if you can look at the chart on the right-hand side, you can see that the percentage of listed net cash companies in Japan is more than 2 times higher than that of the US, as well as European listed companies. So that in fact tells us one thing. So it tells us that corporate balance sheets for Japanese companies are very strong and they are cash rich. So that is a good thing entering a recession. And thirdly, valuations for Japanese equities are very attractive right now. So the region itself is trading at almost a 20% discount to their long-term average. So it's such a huge discount in valuation that also provides a very wide margin of safety in a recession. So in case if there's any downside, there is this valuation, cheap valuations to cushion that downside. So that is something that is very attractive, especially if we are moving towards a recession where there is the risk of further downside. And lastly, with our view of a stronger yen, we also see additional cushion from currency gains for foreign investors. So that could also help in times of volatility and when the market itself is facing some downside. All right, so Asian ex-Japan equities, they are also a hot topic lately after its big rally since late October. But let me share some of the reduce the allocation back to neutral from an overweight position. So moving on to fixed income, our preferences largely remains unchanged. We continue to like high quality as well as short duration bonds. So the heightened risk of a recession as well as our expectation of further economic deceleration really reaffirms our view to stick with high quality bonds, because high quality bonds are traditionally more resilient in a recession and also tend to outperform the more riskier segments such as your equities or even your high yield bonds. And at the same time, we do think that the risk right now is clearly tilted towards rate hikes, as well as holding rates higher for longer instead of rate cuts. And markets right now, they are definitely underestimating longer-term inflation. So what this means is that shorter duration bonds are definitely a sensible allocation and a better allocation to hedge against further rate hikes that may occur beyond market's expectation. And last but not least, the high quality bonds have traditionally proven to in past recessions to be one of the more resilient investment tools. And right now, with higher yields, they can help stabilize the portfolio performance in the recession. So you can see there on the chart on the right, global bond yields are right now quite attractive. In fact, yields have climbed to above 3.5%. So that is a sharp increase just over the past 1 or 2 years. So let me touch on a segment within the fixed income market, which we think investors should remain cautious on, and that is Asian high yield bonds. So recent supportive measures to revive China's property sector has so far seen limited success. We have continued to see developers like Times China, for example, experiencing rating downgrades or even defaults recently. And besides, China's property market remains plagued by a confidence crisis, as we think home buyers are not even convinced that developers can deliver the properties that have been pre-sold. And in order to restore this confidence that has been destroyed over the past 1 or 2 years, it will take a very long time. But in the meantime, demand coming from the consumers is likely to remain weak and therefore will prove not so supportive for the sector itself. And yes, you might see that some data seen in February and March, as shown on the chart here, have stabilized and have shown some minor pick-up, such as the MBS 7 city property prices, as well as the new home sales data. But we do caution that one positive data does not make a trend. And in fact, we question the sustainability of this recovery. We believe that the data do not give a complete picture of the sector's health because there are a few factors. Because number one, they were artificially helped by last year's extremely low base, as well as the pent-up demand from the recent stringent COVID exit. And this data also mostly reflect the first to mid-tier cities, and they leave out the also very important cities like the lower tier cities, the tier 3 to tier 5 cities that can share important information on the health of the sector. And lastly, if you look at the direction as well as the messaging from policymakers, you can see that they have been using the word disorderly expansion. So what they intend to do, what they desire to do, is to prevent disorderly expansion by developers. So what this suggests simply is that deleveraging will still remain the overall emphasis in the sector, and therefore a quick rebound seems relatively unlikely at this point in time. All right, so in summary, here's our recommended asset allocation moving forward. So we see a recession as our base case, and investors should remain defensive. So when it comes to the recession view, we definitely prefer fixed income over equities, as we believe that investors should take a defensive position and reduce risk. And for equity markets, Japan remains our top pick, especially within developed markets. And for emerging markets, we think that the theme is to be selective. So we like Latin America as well as ASEAN, and investors should remain cautious on Asia and Japan as well as China. And when it comes to thematics as well as styles, we definitely do prefer value stocks over growth stocks, while no doubt we think it pays to hold a balance of both, but do have a higher concentration or introduce value stocks in the portfolio if you do not have it at the current point in time. And at the same time, we also like commodity-linked equities, as we expect the inflation environment to also stay higher for longer, and that also is that on top of very supportive supply-demand dynamics will definitely bolster performance for commodity-linked equities moving ahead. And for fixed income markets, we prefer investment grade as well as short duration bonds. Investors should also remain cautious from buying into Asia high yield. As I mentioned, we do think that the rally right now is unsustainable, and we question the recovery of the China property sector. And for currencies, we have two key views. We do continue to expect USD weakness as well as the yen strength this year. So we do expect yen to strengthen against broad currencies, while USD to weaken against broad currency this year. And investors, as a result of this, investors should consider hedging away from their USD exposure, and also for Japanese equities, consider an unhedged share class to maintain the exposure to the yen. So with that, I come to the end of my sharing on the market outlook as well as the MAPS portfolio performance, and I hope I address some questions regarding MAPS as well as to bring to light why we make those changes in early March. So with that, let's move on to Q&A, and maybe you can take some time to type in any questions and I will answer those questions.
Feel free to use the Q&A section to ask questions, and then Colin will be on hand to answer any burning questions that you might have. I think there's a first question for Colin. Do you want to take the first question?
Okay, perhaps I'll give some more time to accumulate the questions first, then I'll take a couple at a shot. All right, I see some questions are building right now. Maybe let me take a couple of the questions. Can you show the Japan ETF in the slide? Give me a minute. All right, I'm not too sure which Japan ETF, because for MAPS side, our recommended fund for Japan is the JPM Morgan Japan Equity Fund, and the ETF, right? We do not use ETF for our performance in to track to have exposure to Japanese equities. And for the outlook, there is no Japanese ETF here. But when it comes to recommended products for Japan, we do have 3 different recommended products. One for growth stocks, Japanese growth, one for Japanese value stocks, and the last one, which is something more market neutral. So maybe let me share a bit on all this. So for the market neutral approach, we recommend Japan ETF, which is the iShares 1. And for the value exposure, we recommend the Eastspring Japan Value Fund. And for the growth exposure, which is the one I've shown earlier, we recommend the JP Morgan's Japan Equity Fund. Okay, so what is the outlook of interest rates in 2023 and 2025 horizon? For a big part of this year, we do think that rate hikes will definitely still be on investors' mind and still be in the Fed's mind. So we do see maybe the high possibility of 1 or 2 rate hikes moving ahead, especially in the second quarter this year. And the reason so is because two things. One is sticky inflation, and second one is the labor market, which is still tight. So with a sticky inflation, especially coming from the re-acceleration of the core goods component, as well as some parts of the core services, we do think that inflation will still remain relatively high for the next couple of quarters. And the second part, which is labor market, while the wages are starting to come down, the labor market is starting to loosen up. It still is tight as compared to what the Fed would like to see, which in some case is a pickup in the unemployment rate, is a pickup in the jobless numbers. So with the labor market still tight, that puts a lot of pressure on wages, and with wages still growing relatively strong despite declining, there is still that potential upwards pressure on inflation. So because of all these factors, we do think that the Feds are likely to remain aggressive for this year. And we do see the possibility of 1 or 2 rate hikes in this quarter, and for Feds to remain steady and hold rates for the rest of the year. So we see little possibility of rate cuts, in fact, in the second half of the year, contrary to what the markets are expecting right now. So that is for this year. But moving forward to the next few years, I think the next few years itself will be a bit tricky, because as a house, we believe that the long-term inflation is being underestimated by markets right now. There are several structural reasons that is supporting long-term inflation, such as the reshoring, such as the higher commodity prices globally and across the commodity spectrum as well. So there are all these factors that is pushing inflation rates higher in the long term. So we do think that with higher inflation rates in the long term, it means that the Fed will not be able to cut as easily and as quickly as what we've seen in the previous few years. All right, so moving on to the next question. With the recent release of GDP and other economic data of China, will you reconsider the potential of China's stocks? All right, so for our China thesis, a lot of it has to do with long-term outlook. So let me quickly go through some of the factors why we turn negative on China as a whole. So firstly, we think that the shift towards a top-down government-controlled economy itself is not too ideal for long-term growth of the economy as well as of the companies, and particularly for the companies, because corporate profitability itself will likely take a backseat to the government's direction and what the government plans to achieve. And because of that, we think some companies may struggle, and I'll touch a bit on that later on. And because of that, we think on the long-term wise, corporate outlook might not be too ideal. And also economic growth will likely slow long-term economic growth. And at the same time, when you look at certain important risks in China, which is the geopolitical risk itself, we think with the shift in the government direction, geopolitical risk will pick up. And a big part of it comes from the tensions with the West, as well as tension with Taiwan. So those are very prominent areas where we see risk building and not subsiding, and with higher risk itself, it definitely commands a higher risk premium. So investors should be compensated more for investing in China because of the higher risk. So not only do we see China investing in China becoming slightly riskier because of the higher risk from what I mentioned earlier, but also long-term outlook in terms of the economic outlook as well as the corporate outlook are still being underpinned by the shift in the government direction. So with that, the long-term view, our long-term view for China remains unchanged, and we still hold a cautious view on Chinese equities as a whole. But I would like to make it a point to say that within China there is China A shares and China H shares. So for China A shares, there are more companies that are more aligned with the government's direction. So there are more companies, say for example, within the hard tech industry, that there's more aligned to the government's direction. For example, in terms of their semicon players, as well as certain electronic players that they want to compete with global international companies. So all these companies that that is being backed by government's direction should be more ideal as compared to their H-share counterparts. So they definitely benefit from the policy tailwinds. So there is this separation between who will do well within China stock markets, even though we have a cautious view on China as a whole, but there is this separation on some parts of China will do well and some parts might not do well. So the parts that will do well are companies that are aligned with the government's policy direction. Let me take the next question, which is similar to this. So what will be the impact on further China-US tension? So I think this is a very important question because over this past quarter, in fact, in the past quarter as well, we see the China and US tension picking up. And this is not a good thing for investors because with more tension, it also represents more uncertainty ahead, and investors and markets hate uncertainty because they cannot price assets well, and as a result of that, the risk premium of your asset increases. So investors do need to be paid off higher for investing in a particular assets, like I mentioned earlier. And as a result, for example, your equity markets will definitely command a lesser equity valuation. So on a technical basis, if you look at the equity markets, for example, because of the rise in tension, we do think that to price that in to the outlook of Chinese stocks, we do believe that in general, valuations have to fall, and the fair valuations for Chinese equity markets they have definitely come down, and as a result of that, the upside potential have also come down. So one of the impact coming from this tension is a decrease in upside potential, and a lot of it has to do with pricing in the risk premium into equity markets, and therefore reducing valuation and reducing the upside potential. But also at the same time, when you look at prices of Chinese stocks, for example, as well as US stocks. So those that have been affected by tension or are exposed to this tension may tend to see greater volatility moving ahead, and as well as greater potential for equity downside. And because I said earlier, investors don't like uncertainty because it's hard to price uncertainty inside, and therefore there'll be a lot of volatility when it comes to the stocks reacting to the news coming from the US-China tensions. So in summary, the impact will be lower upside potential, at the same time price volatility, as well as potential price downside coming from the impact of the US-China tension. But of course, at the end of the day, there are news that are just noise, and there are news that are serious and represents a permanent increase in the risk. So I think it is important to determine which one is noise, which one has a material impact, and those that have material impact definitely will result in what I mentioned earlier. All right, so I'll take on the next question. Overall, Asian equities, they are down. How do you suggest we do? All right, so like I mentioned earlier, Asian equities were hit badly last year. I think they're down by about more than 20%. Recently, they have jumped by about 16% or so. So, but they are still down as compared to where they were like early last year. So our recommendation, overall our stance is we remain neutral on Asian equities, and investors do have to be cautious on Asian equities. So for investors that have a heavy weight of heavy allocation to Asian equities in their portfolio, we recommend investors to trim down the Asian exposure. At the same time, if you have an overweight position for Asian equities in your portfolio, we also recommend investors to trim down the exposure as well, perhaps to neutral, to a neutral allocation. And aside from that, there are other stuff that you can do. For example, within the Asian markets, there are certain, we think one theme for this year is to be selective and not to have exposure to Asia as a whole, but to look within Asia and pick markets that could be winners. So picking the countries and picking the markets instead of having exposure to the broader Asia, that is also something that you can consider. So within the Asian markets, the markets that are relatively more attractive and also have relatively higher star ratings compared to the rest are the Singapore equities, South Korea, as well as Taiwan. So those three within the Asia ex-Japan region. So instead of having exposure to the entire region, we do recommend exposure to countries as well as markets. But at the same time, investors can also consider ASEAN as a whole, because ASEAN as a region, we think is a more resilient exposure to Asian equities versus Asia ex-Japan. So what I mean by that is, firstly, ASEAN equities have lesser exposure to China, so you do not have that China-related risk or Hong Kong-related risk coming from like Asian ex-Japan equities. So that is being cut if you have exposure to ASEAN. And secondly, if you look at for example, look at the correlation between ASEAN versus global equities versus US equities versus all these major equities indices, the correlation between ASEAN and major equity indices are the same as if you compare Asian equities versus major indices. So what this means is by allocating into ASEAN equities, you can do away with the China exposure. You can reduce the China exposure, but maintain the similar exposure to all these major equity indices. So that is another good thing. And lastly, we think ASEAN equities are more resilient because on a long-term basis, why they are supported by the reallocation or the moving out of supply chains from China to the rest of the world, and ASEAN is a big beneficiary of that. So to sum it up, what investors can do is reduce the weight if they have overweight ASEAN equities, or they have a heavy weight on ASEAN equities. So that is to scale them down, number one. And number two, they can consider, instead of allocating into ASEAN region as a whole, they can consider allocating into the single countries, which I mentioned earlier. They can also consider allocating into ASEAN, which is a more resilient exposure to Asia, to Asia as a whole, the dynamics of Asia relatively to Asian ex-Japan equities. So these are some of the stuff that you can do. All right, I'll take the next question. What do I think about Singapore equity markets? In short, I think Singapore equity markets are still quite attractive relative to the other Asian markets. Yeah, so there are a couple of factors supporting the Asian equity markets right now. Number one, I think the more obvious one is that valuations are still relatively attractive, and that is something I think that is increasingly hard to find within Asia, the Asian universe as well. Because what we've seen over the past quarter is that a lot of these Asian markets have rallied, and because of the positive news coming from China, and therefore valuation has shot up for many of these Asian markets, and Singapore itself is still finds itself to be relatively attractive when it comes to valuation, and that offers it some cushion in times of a more challenging macro backdrop. So that's one. Number two, we think the long-term outlook for Singapore as a whole, as well as Singapore equities, are generally supported, and a big part of it is coming from the reallocation of wealth from China's side to the Singapore financial sector. That's one. And also, in a more near-term basis, the tourism effect coming from China as well as coming from many of these Asian markets, Asian economies reopening. So that is also lifting Singapore's growth. So that is both on. So you might see recent data showing the GDP itself of Singapore is not too ideal, but we do think that that is the function of the whole world slowing down and effectively weighing on the Singapore economy. But overall, we think long-term wise growth, Singapore's growth remains quite supported by several of these long-term structural growth trend. And in the near term, we do not think growth will fall off the cliff, especially with the tourism boost as well as some of the retail spending boosts coming from the spillover coming from all of this. So our view for Singapore equity remains relatively positive. So we are still quite positive on Singapore equities versus the rest of versus most of the Asian markets. All right. Okay, let me take on the next question. If you think inflation will stay long, do you have any view on commodities? Shouldn't it go up? Yes, we do have a view on commodities. So maybe in light of the time, I'll quickly answer this question. Yes, we do have a view on commodities. Overall, we are still positive on commodity prices. We think commodity prices are supported on a long-term basis, and because of factors like weather, underinvestment, and all that. So that is something very supportive for commodity prices over the long term. And also, if you look at what has happened recently, we find that there is an issue of undersupply. So while demand may come down because of a recession, but supply has also came down quite a bit, especially after the after COVID hits. So there is definitely a supply mismatch even at this point in time. So for most of these commodities, they are also supported by positive supply demand dynamics, and on top of that, we see long-term supportive factors for commodity prices. So overall, for our view of commodity prices is that we think prices will remain supported, and as a result, commodity-linked equities should benefit if prices remains relatively supported, even if they are not as high as what we've seen over the last year or so, which are really an anomaly. So that is our take for commodity market. And let me jump on quickly to the next question. Okay, it seems that wages stays high in the US because of a lack of labor supply. Why does the US not receive more foreign workers? Good question. I think the nature of this question is more about policy direction. So I will try to answer that. I think at the end of the day, to receive more foreign workers or not, I think that is something that is hard to say at this point in time. But what I can say is the US do not have a shortage of workers. In fact, they have a lot of workers, both legally and illegally from Latin America areas as well. So there is no shortage of workers, but I think a big part of it is that over the past decade, 2 decades, there have been globalization effect in place. So companies are seeking more and more. A lot of companies have seek to set up plants, set up supply chains away from the US in cheap areas like China, like India, for example. So all these are slowly starting to reverse, and they are pulling back. They are doing reshoring, they are doing friendshoring, so moving supply chain and companies to neighborhood countries like Mexico, for example. So they are doing all that are reversing. So there will be a need for greater labor in the future in the US. But at this point in time, it is increasing, but still not very, very significant, but it is a slow but certain process. So will you recommend investment in the US 20-year Treasury given the possibility of a rate decrease next year? So for us, I think our belief is that the rates will stay higher for longer because of our view on inflation. So with that said, I think without material downwards movement in the rates or in yields, for example, I think it is hard to recommend a longer duration treasury. But theoretically, if rates were to come down significantly next year, longer duration theoretically should benefit more. But it goes in contrarian with what we think will happen to interest rate next year, which we expect them to be kept higher for longer. All right, I think I answered most of these questions. So let's maybe give a couple of more minutes to see if there's any additional questions.
Right. Give me a moment. Sorry. I think we will open stay along for another 5 more minutes, and then we see if there's any more questions that comes in. I mean, if you have any questions that you're typing or you're thinking, feel free to type it down, and then Colin will be here to answer.
All right, I see one question. What is your view on China recession and any possibility that China will fall into a recession? All right. At the moment, there is greater risk of a US recession than a China recession. So, assuming isolating China by itself, will it fall into a recession? There is a chance. I wouldn't put the risk as high as the US. And for that to happen, we think several conditions have to be met. Firstly, globally, the slowdown have to be there, meaning to say that US have to fall into a recession, and perhaps European growth have to slow, and that should affect China's growth when it comes to the exports channel, and that also will slow China's growth. But the second condition is that internally, we think consumption have to deteriorate. So a lot of people have been talking about a consumption-led recovery in China. We think that have to fail for China to have a recession. So a consumption for China to be for China to have a recession, again, 2 conditions: global growth have to slow. So US growth have to slow, European growth have to slow first, and secondly, internally, China's consumption would then have to slow as well. So these 2 factors, I think, together would likely raise the chances of China falling into a recession. Should a new reserve currency be started, what will be the impact on the US dollar and stocks? All right, I think that depends on what the reserve currency is. I think there have been a lot of talks on the CNY. So I think if the new reserve currency is to be started, I think that would push a lot of flows up from the US dollar into this new reserve currency, whatever it may be. And the chances are, if it is a major currency, I think that will have depreciating pressure on the US dollar. So that itself could weigh down on the US dollar, and the impact on stocks itself will have to be determined on which region stocks it is. So for example, if it's US equities, I think the impact will be more clear, because a falling US dollar will reduce the FX gains for US stocks for foreign investors, and at the same time, that may reduce some of the sentiments from US stocks. So that itself could be further downwards pressure for the US stocks. So 2 things, I think, primarily for stocks, sentiment basis, stocks will go down. Sentiment worsen because of the outflow from the US dollar, and secondly, the FX loss. So at the surface level for US stocks, I think those 2 will weigh US stocks down. So regarding the outlook for silver, this is not something that we covered. So unfortunately, I might not be able to answer this question. But if you are looking for a commodity, for example, such as gold, maybe I'll shed some light on some of my precious metal like gold. So for example, gold is highly inversely correlated to real yields, real rates. So this is the nominal rates minus your inflation expectation. So if real rates come down, gold goes up. vice versa. So what we have been seeing lately is that real rates have been coming down, but this is something of a disconnect in the current backdrop because the Fed wants to tighten the economy. So that is one of their goals. And to do so, real rates have to move higher. So if real rates are higher and if they are above zero, that has an effect to tighten the economy. So that will slow growth down as well as slow inflation down as a result. That is one of their outcomes. So policy direction wise, there is a bias for higher real rates. And at the same time, liquidity in the money affects real rates. So if there's a lot of liquidity in the market, as we've seen over the past quarter, the injection of the injections of loans and the Fed's coming in to support the US banks through all those measures have injected a lot of liquidity in the market. So that actually pushed real rates down. So if the liquidity will be withdrawn from the market, as I expect in the second half of the year, there is a chance for real rates to move higher. And overall, these two factors points to real rates likely to move higher than lower. And with this direction, I think the outlook for gold itself might not be so appealing.
All right. Thank you, Colin, for so much answering all the questions. And okay, I think we will stop the questions and answer section for now. If you have any questions, feel free to email us. So I just want to say thank you, Colin, once again, for the wonderful sharing and also to be here to answer all the burning questions that our attendees have. I mean, there's a lot of questions that you've answered. And then also a big thank you to everyone here who is with us this evening. So I hope you will find the sharing useful in your investment journey. So I'll be sharing a slide. All right, so right now on the screen, is our social channels, and we invite you to connect with us. So I will be leaving this slide on for a while. Then with that, the webinar has ended actually. And have a great evening, everybody. We will see you at the next one.